The fractured truth. Payrolls mirage, tariff, steel rain, and the quiet before the storm. Greetings, traders. This is James. Another day, another puzzle. Now, let's look at the tape. It's like a mirage over the Saudi desert. The S&P, it's up 0.37%. And the Nasdaq is barely green. And the Dow is up 0.49%. And these are all small moves. But underneath the hood, landmines big enough to blow up anyone who's not thinking right. Now, today is not about what stock to buy. It's about what you still dare to buy. It's about what stocks you still dare to buy at all. Now, let's look at Tesla. Tesla's got a faith crisis. It's like when Musk meets gravity. So Tesla's down another 3.31% today, closing at 348.64. This follows last Friday's 5.4% hammering. That's not a production issue, that's demand side, and there's red lights everywhere. And worse, there's energy storage. At 8.8 gigawatts per hour, it's down 15% year over year. This is missing the analyst estimate of 14.4 gigawatts per hour by nearly 40%. It's the first year over year storage decline since Q2 of 2022. And JP Morgan's Ryan Brinkman cut Q1 earnings per share forecast from 43 cents down to 30 cents. Price target of $145, implying another 60% downside. You know what? When a stock's valuation is built entirely on the next guy is crazier than me, the moment fundamentals crack, the fall wakes everybody up. And Tesla's PE ratio is still 295x. 295 times earnings, demand falling, storage falling, analysts downgrading. Is this a growth stock or the most expensive gamble on the floor? Now let's talk about NVIDIA, the first real screw loose in the AI dream factory. NVIDIA is down 0.26% today to $176.93. Small number, but worth sitting down for. KeyBank drops a bomb. NVIDIA's next generation AI chip Rubin is hitting HMB memory supply constraints. Both SK Hynix and Micron are struggling. Production volume for 2026 cut from 2 million units to 1.5 million. You get what this means? After all the AI hype, the market hears for the first time a physical ceiling. Hardware supply chains have friction. Now, KeyBank keeps the $275 target. I'm not here to deny NVIDIA's long-term story, but the question is, has the market already priced a perfect, frictionless AI narrative? When supply chain friction becomes real, when production cuts are no longer rumors, how long can NVIDIA's valuation hold? This is a game between patient capital and fast money. Which side are you on? Now, let's talk about macro tension. There's two signals ripping the market apart. First, we have the labor market. April 3rd, non-farm payrolls up 178,000, well above the 65,000 estimate. Unemployment fell to 4.3%. Looks like strength, right? Aha. But let's peel back the onion. Healthcare added 90,000, largely a technical rebound after strikes ended. February payrolls revised down again to less than 133,000. February payrolls revised again, they dropped 133,000. Now, one step forward, two steps back. This isn't economic strength. It's noise packaged as solid. Now, meanwhile, the Middle East has fundamentally changed the energy game. The Strait of Hormuz still blocked, oil up more than 50% cumulative, West Texas Intermediate at $110, national average gasoline above $4, California at $5.88. Jamie Dimon's warning, oil this high could trigger a recession and bear market this year. And here's the killer. These two forces are fighting each other. Strong payrolls keep the Fed's hands completely tied. And here's the killer. These two forces are fighting each other. Strong payrolls keep the Fed's hands completely tied. The CME tool now pricing out almost all 2026 rate cuts. But soaring oil is reigniting inflation, even reopening the debate on hikes. The Fed is completely trapped. Can't cut to save growth, can't hike to kill inflation, Stagflation risk is now becoming a reality. And now, let's talk about tariffs. The tariff shoe is still hanging on. 1 year after Trump's Liberation Day, April 2nd marked 1 year since Trump's so called Liberation Day tariffs, 34% on China, 20% on the EU, 46% on Vietnam, triggering a global sell off. And 1 year later, some tariffs have been adjusted, but the White House just launched a new Section 301 probe targeting China and the EU, Japan, Switzerland, and a dozen others. So, meanwhile, the US also imposed 100% tariffs on imported patented drugs. So, I noticed an interesting shift in language. People aren't talking, oh, America first anymore. They're talking global ex US allocation. Since last April, Shanghai Composite, KOSPI, Nikkei 225 have all outperformed the three major US indices. The American exceptionalism story, told for over a decade, is quietly being rewritten. High US equity valuations surging, federal deficits, Middle East entanglements. These are a new narrative variables. If you're still using a 2019 playbook, you're already behind. Now, let's talk about Goldman signal. Fast money coming in, but with conditions. So Monday, Goldman dropped a note. The fast money crowd, CTAs and volume target funds, sold about 240 billion of global stocks in the past month. But that selling is fading. They estimate net buying of 55 billion over the next month, of which 20 billion of that is into US stocks. But here's the math. Goldman says if the S&P rallies even 8% in the next month, systemic funds could add 220 billion in global buying. But if it drops another 10%, that triggers another 110 billion in selling. Now, mechanical buying or mechanical selling? Well, it depends on the narrative direction. Goldman notes the S&P's 500's key reentry zone is 6720 to 6740, and right now we're around 6600. So this tells you something very important. The market isn't moving by value discovery anymore. It's driven by cascading algorithms, signals, and butterfly flaps its wings in the Persian Gulf, and algorithms in New York sell stocks. That's 2026. Now, let's talk about when philosophy meets singularity. What this calm really means on the surface. The indexes are sideways. Amazon is up nearly 4%, Cisco is up 2%, and the Mag 7s are up 1.13%. But energy is down 2.81%. This is a deeply fractured market, and all the AI giants telling stories, traditional energy being dumped, consumers are struggling, geopolitics overhead, and there's a tariff policy swinging. So, why are indexes up while individual stocks are churning? And why such a strong jobs report, and yet the Fed can't cut? Why are all oil prices up, but energy stocks are down? This is what I call singularity thinking. The market is approaching a point where multiple forces resonate together: rates, energy, tariffs, the Middle East, AI supply bottlenecks. These variables used to move independently, but now one variable triggers three others. The system has entered a non-linear phase, and linear thinking is dead. So I'll tell you, when markets are like this, doing nothing is often the best strategy. Don't fix your roof before the storm. Don't fire before the enemy is out in the desert. Wait for data to clear. Wait for the direction to confirm. Then keep plenty of liquidity, because cash is the strongest hedge. Now, that's the real face of the US stocks today, April 7th, 2026. Indexes look good, they look fine, but underneath are scars everywhere, and Tesla's faith is cracking. AI hardware bottlenecks are showing up everywhere. Energy inflation and labor strength are really tearing the Fed apart. So, tariff echoes are still in the air, and algorithmic money is ready to flip. Now, what's my take? Stay hyper aware, stay liquid, spread your risk, and don't carry oversized bets on any single variable, because today, one black swan can flip the entire narrative. So stay sharp, stay humble, and trade with your eyes wide open. This is James. See you tomorrow.